Moving money from your business account to your personal account is not the same thing as paying yourself. In fact, the IRS treats those as two completely different events. And if you've been doing the first one and calling it the second one, then we need to talk. If we haven't met yet, my name is Jen Nixon. I am an AFSP tax analyst here in Houston, Texas, and I help small business owners keep more of what they earn legally. And this is the T on taxes, where I give you the T on all things to do with your taxes. And by the end of this, you're going to know three things. One, which method actually applies to your business. And two, how much you're supposed to pay yourself. And three, the one habit that is quietly causing more problems than anything else. So let's get started with what these two words actually mean, because almost everyone has one of them wrong. Now, a draw is you taking money out of a business that you own. No payroll, no withholdings, nothing is getting taken out. You move it and it's yours. But a salary is different. A salary means that you are an employee of your business, and there is payroll, there is withholdings, there's even a W-2 at the end of the year with your name on it. Now, here's the part that trips up almost everyone. A draw is not a business expense, okay? It does not reduce your profit. It does not lower your tax bill. I mean, not by $1. The only thing it affects is your equity into the business. Now, I've had people show me a year of the books where they wrote off like $60,000 of owner's pay as an expense. Honey, that's not a deduction. That's an audit waiting on you. So here's the rule underneath all of it. If you're a sole proprietor or a partner, you are taxed on your business's profit. So not what you took out. So you could leave every single dollar sitting in a business account, take nothing home, and still owe tax on all of it. So I want you to read that twice, because that one sentence explains most of the surprise tax bills that I see in April. So which one applies to you? Truly, that's not up to you. It's up to how your business was set up when you first started it. So sole proprietors or single member LLCs, you take draws. That's it. You cannot put yourself on payroll. You cannot write yourself a W-2 because your profit flows on the Schedule C of your personal 1040 tax return. And you pay self-employment tax on it, which is about 15.3% on top of your regular income. And I want to be really clear here, because this one comes up every single week for me. Forming an LLC by itself does not change any of this, okay? An LLC is just a legal structure. It's not a tax structure. You're gonna do the same draws, same tax. Partnerships or multi-member LLC. Now, partners take draws too, but there's a second tool called guaranteed payout or guaranteed payments. And that's money that's paid to a partner for services regardless of profit. And it is deductible to that partnership, and it will typically show up on your K-1. Now, S-Corps, this kind of changes how you get paid completely. If you own an S-Corp and you work on it, then you are required to pay yourself a reasonable salary through an actual payroll. Now, before you take a single distribution, it is salary first, then profit. And then C Corps, you're an employee. You take a salary, and any profit that's paid out as a dividend is then, that gets taxed second time on your personal level. Quick thing, if this is hitting you, I want you to hit subscribe. I try publishing a new T on taxes about every week. Now, if you're an S Corp, this next part is the whole ballgame, because the S Corp's advantage is real. Okay, your salary gets hit with payroll tax, but your distributions don't. So the lower the salary, the lower the tax, which is exactly why people start to get a little greedy with it. And the IRS knows. So a reasonable compensation is actually the single most examined issue on an S Corp return. What does reasonable actually mean? It's not just a percentage. Okay, let me say that louder for the people in the Facebook group, okay? There is no 60-40 rule. This is just some rule of thumb that someone made up, okay? It's not in the code, it's not in the regulations, and it's not going to defend you when you go to an audit, okay? So here's what the IRS is actually looking at. Your training and experience, your duties, and how much time you are actually putting into the business. What comparable businesses are paying for that same work, and what you pay your other employees. And also, of course, your history of distribution. Now, if you strip that all down, it becomes one question. What would you have to pay someone else to do your job? Okay, that is your number. And you're gonna wanna document how you got there. And then I would recommend revisiting it about every year. Now, what happens if you end up lowballing it? Then the IRS will then reclassify those distributions as wages. You will owe back payroll taxes, plus the failure to deposit the penalties for the payroll taxes and the failure to file penalties for the payroll taxes, plus interest. And there's actually a well-known case where an owner paid himself about $24,000, and the IRS court ended up resetting it to over 90. If you're curious, that's Watson versus Commissioner. If you're curious about that. So, but on an honest note, and because I'm really not here to sell you on S corps, payroll isn't free. There's the payroll service company that you need to pay, the quarterly 941s, the W-2s, state unemployment. It's a whole separate business return. And below a certain profit level, that overhead can actually really start to eat away into the business's savings. Doesn't necessarily, move to S Corp. Here is a habit that I do see a lot, and it has nothing to do with your entity or the way your business is structured. Okay, you pay the vendors, you pay the software, you pay the contractors, and then whatever's sitting at the end of the month on the 30th, that's what you pay yourself. And I get it. I go, it totally feels responsible because it feels like you're putting the business first. But unfortunately, that's costing you in about 3 ways. Okay, first, you can't plan anything. Okay, your income is different every month, so you can't set estimated payments, and you won't even be able to budget at home. And then when April comes around, it's a huge guess. You have no idea what you actually made. 2, if you are an S Corp, this is exactly what makes reasonable compensation indefensible, because you've got random amounts, no schedule, and no documentation. Okay, that kind of pattern is a audit red flag. And 3, and I know this one is gonna sting, if the only reason your business is breaking even is because you are working for free, then your business isn't even breaking even. Your unpaid labor is just subsidizing it. And if you can't see the problem, it's because you've never seen it shown in the numbers. So here's my suggested fix. Okay, 3 moves. First, pay yourself on a schedule. Same date every month. And then 2, set about an amount as a percentage, not a leftover. Also, you wanna go ahead and move that 25 to 30% of that profit to a separate tax account on the same day. This way you have it set aside to pay for any taxes that you need to do either quarterly or at the end of the year. Start smaller, then it feels impressive. Consistent and modest beats sporadic and large for your planning and also for your defense in an audit. Okay, so one more time. Sole proprietors and single member LLCs, you have draws, and that draw is not a deduction. It doesn't come from your expenses. It is just a draw. And then partnerships, you have draws plus guaranteed payments. Okay, S Corps will have a reasonable salary first, then distributions second. And then C Corps, you're just flat salary. Just watch out for the double tax. But whatever you are, you need to pay yourself on purpose, not on the leftovers. And if this helps, I want you to hit that button so more people go ahead and find that, hit that like button. And then until then, keep on sipping. All right, bye.